It is time now for Futures in Focus. We're keeping an eye on oil. It's rising. U.S. stockpiles, of course, declining. Washington is putting pressure on allies not to buy Iranian crude. And then prospects for shipments from Libya are dimming at the moment. With WTI at its highest since late 2014, let's go to the CME and bring in Brian Battle, Trading Director for Performance Trust. Brian, is $73.60 a good price for a barrel of WTI right now?
It sure is today, Vonnie, and you just mentioned all the things that affect oil: supply, demand, and price. Supply side is affected. We just had an OPEC meeting, which is interesting. Saudi Arabia, and it looks like Russia cooperated. That was unusual. Supply disruption in Libya. A couple of terminals are closed in Libya because of there's a rebel fighting there along the coast, so a couple of terminals are closed. And then, of course, Venezuela is devolving into anarchy, so they are just losing their ability to produce. So the supply side is getting impinged, and we're seeing that price at 73. The average price is a lot lower than that. This is the high in the past 3 years.
Were you anticipating a 10% rise in oil in the last 10 days?
So no, the expectation was the OPEC meeting was going to be organized and coordinate. Saudi Arabia effectively was going to coordinate an upper limit, about $1 million barrel increase, which was expected, and it wasn't taps open, and everyone seemed to cooperate. The bigger story, I think, and the threat to $73, you asked me if 73 is right, is this the overarching threat of this global trade war that's affecting everything. First of all, because if there is a trade war, if the politics becomes the actual policy, that's just bad for global GDP. It just slows down the world economy. But probably more effective, and the thing that's affecting it more, is the price of the dollar. So we had the Reserve Bank of India complain about the dollar. Emerging markets are getting crushed because of the value of the dollar, and that's probably going to hold oil back because there's just going to be less demand if the price gets too high.
What do you make of the backwardation right now? The front month, what is it, $1.54, even more now? Cheaper than the September contract.
Yeah, that's a signal of stress and uncertainty. So if you're going to trade oil, be careful to have tight stops, because the risk, we're not trying to measure supply and demand risk, because that you can kind of suss out, and Libya will calm down, Venezuela will get a new government. But what this global trade war thing is political risk. You can measure interest rate risk, you can measure credit risk, you can't measure political risk. And the White House says something different every day. It's not that we have a good policy or a bad policy. It changes depending on who you ask. So that's why we're seeing all of this volatility, certainly in stocks. The bond market doesn't believe it. The 30 years at below 3%, third time this year, and it's the bond market is voting. There's not going to be inflation. There's not going to be growth, and that's going to effectively, it's going to reflect on the broader markets. But oil is definitely might be at the top of its range here because of all the things that are wrong with global demand.